The former Philadelphia Fed President Patrick Harker writing, Warsh has three elephants in that room: inflation, the Treasury market, and the fiscal situation underneath both. Watch what he addresses rather than what he promises. Patrick joins us now for more. Patrick, welcome to the program, sir. Always good to hear from you. Out of those elephants, what does he have the most influence over?
Yeah, good question. So he clearly doesn't have influence over the long end of the yield curve. That's never been the case, right? He does have influence over inflation and the credibility of the Fed in terms of inflation fighting. It's not enough just to say we're going to be tough on inflation. You actually have to do something. Now, I think I was listening to your comments earlier, raising the short end, by 25, 50 basis points, is it going to make a huge difference? No, but it's signaling what the Fed means when it says it's tough on inflation.
Patrick, do you think there are questions being asked of this Fed chair that weren't being asked of the former Fed chair? Is there something about the switch here that has raised questions about credibility that little bit more because of the pressure this institution's come under over the past 18 months?
No, I don't think so. I don't think that's the issue. I think the issue is the circumstances we have, right? Right now, we have inflation. We're going on to 6 years here soon of inflation above target. The Fed has to show that it's serious about getting that under control, getting to 2%. And the idea that we change the target, change the goalpost right now in the middle of this fight, that's just, you have to take that off the table. It makes no sense.
Patrick, there is this argument, though, that when Chair Warsh speaks, that he doesn't really need to do any cleaning up, that the long end yields on 30-year yields, they haven't moved that much, as John pointed out, only 10 basis points, that his whole aim is not to hold the market's hand. Do you think that there is an element of cleanup that he needs to do from his July press conference?
Yeah, I think he actually has to take action. As people say, words are cheap. He actually has to show, and this is what you're seeing with the other committee members right now, those who dissented and all the others who are out talking right now. I mean, Susan Collins, my old colleague, she's pretty much a centrist. And the fact that she is now saying we're probably not restrictive is a real tell.
What does taking action look like?
Well, I think they just have to raise the Fed funds rate. Again, it's not going to affect the long end. I get that. But I think it's an important signal to the market.
Patrick, what has changed? You mentioned that things have changed. Certainly the bond market's way more unforgiving now than it was in years gone by. What's changed about the economy that's led to less confidence about ultimately achieving this target anytime soon?
Well, some of it is the build out of AI, right? It's a great sucking sound. It's sucking all kinds of capital in, all kinds of goods, transformers, you name it. So that is different in that you're just seeing this incredible build out in a very rapid time period. So that's one. The second is the war. I mean, let's face it. We talk about supply shocks, and if you read the textbook, you're supposed to look through supply shocks if you're a monetary policymaker. But these supply shocks keep coming at us. They're off, on, tariffs on, tariffs off. It's hard to keep looking through those. They're not so much random acts of God. These are deliberate actions by nation states or within our own administration. So those are not shocks in the traditional sense, and they are very different than what we've experienced in the past.
Just on the first point, the AI build-out, one debate we've had on this program, we'd love your input on how rate-sensitive that build-out might be, how rate-sensitive that build-out might not be. Where would you come down on that?
Well, it hasn't to date, right? I think what we're seeing right now is it really doesn't matter. I mean, they are rushing to build out this infrastructure. But what we know through history is, that it's going to take time to actually see the productivity on the other side. We're going back to the 1980s, baby, bell bottoms, disco, and the word re-engineering. Remember this word? That we have to redesign our production processes, our service delivery processes to take advantage of new technologies. That doesn't happen overnight. So, that's what we're seeing right now, this rush to build this out. But we're not going to see the payoff for quite a while. It's going to take time to move into the economy.
Well, and that's part of the difficulty, especially if they haven't been rate sensitive to date, Patrick, of what raising rates would actually do to these hyperscalers, especially when the new central bank for them in town seems to be NVIDIA, that's happy to finance everything from the entire ecosystem. So if you raise rates, what would eventually then be the transmission mechanism to the AI hyperscalers, if that is part of what's changed and part of the issue for this economy?
I don't think that the hyperscalers will be affected by a rate increase. What they're going to be affected by is people who start to question, where's the beef, right? Where's another phrase from the 1980s, right? Where's the money? And so investors may get a little skittish at some point.